our theme from the beginning of the year has been we're just basically going to go sideways until the Fed's done raising rates. Sideways or down. And when the Fed tells us um, they're at a point where they're not going to raise anymore, and at that point going forward, we'll know it's a good time to get started to look into the stock market coming up again. And looking at our earnings calendar of events, we like to keep track of the holidays. Next Monday is going to be a holiday. Not this coming Monday, but next Monday. So market usually gets juiced up around those times because people have happy feelings in their stomach. And the other thing we keep to look forward to is 14th and 16th of next week. We have inflation reports, the PPI, CPI. There are personal consumption, PCI, personal consumption index, and or CPI is another inflation report. So that's gonna move the market around. So we're seeing when's the next market Fed meeting? Next Fed meeting is March 22nd. So we got a while to go before they're probably going to raise the rates another quarter point. And we have a let's see, the Fed never fights market rates, the 2-year. So the 2-year is up 6.5%. So it's up to 4.52%. So this basically tells us where the Fed's going to start raising rates until. So we're just amateur rate predictors right now, but it looks like the market could have some well, it's got a ways to go sideways before we get real clarity of what's going on in the big picture. All right. So what else is happening? We have earnings reports start to come out in April and March. So that's another good thing to look forward to. S&P is down 2% since last week, maybe more today. You see. There's been a dash for trash recently. That means people are bidding up stocks that are worthless or not very good fundamentals. So you want to ignore that kind of stuff. Anything that has zeros, negative numbers in our stats that we're looking for, you have to not get sucked into that. So Fed never fights market rates. We mentioned that. That is still reducing the balance sheet. That's like having a quarter point increase in rates on a regular basis. Okay, so our theme since the beginning of the year is so what worked last year will continue to work this year until the Fed is done tightening. So dividend stocks that have the ability to raise prices and without hurting demand. Those are the stocks that are going to be holding up better in this time. Okay, so we always keep track of our balance for the market to go up or down. We have a holiday coming up next week. It's 10 days from now. There's not really many earnings catalysts in the near future, so that's not going to help. Every month, inflation is getting better, so that's why we have inflation's been going down for the past 6 months or so. So if it keeps going down, we could have a point where Fed is neutral here, and then maybe towards the end of the year, beginning of next year, the Fed starts reducing interest rates. So let's see. So inflation's getting better. We're currently overbought and going down in our stochastics and in the metrics we're following. So you see, Pepsi had really good earnings this week. They showed that they could raise prices, and they can still grow at like a 7 to 10% and pay a dividend, which is and it's one of the only stocks we're following still in an uptrend. And then let's see. All right. So we're still looking for low peg ratios stocks. We had a month and a half of, everything that didn't work last year was working this year. So all the tech stocks had a really good January, but you still have to keep in mind the valuations and the forward earnings of these stocks and whether they're changing or not. So we're going over a couple stocks today that we've been following just to check on their valuations. Because good stocks, all stocks go through periods of times where they're overvalued and undervalued, and you can't get sucked in to buying more of the stock if it's overvalued. You just have to be willing to sit through times, even though it's an overvalued stock. You can't, if it's undervalued, then you might want to think about looking into buying that. So low peg ratio is the key for this year. And any time that we have a sell-off, we're going to look for the stocks with the low peg ratios. And if the stock we're following is going down exponentially, we have to look at, where is it fairly valued? Where is that peg ratio of 1 valuation? And that will give you a good sense of when to start buying if you're not invested yet. And it's also a good time to look at high-yielding stocks. Because this, if you look at our calendar, if you're looking to buy or get into some high-yielding part of your portfolio, so in other words, you have a certain amount of your portfolios is growth, a certain portion is high-yielding. That's like a simple way to look at things. This is one of the best times to look at the high-yielding portion of your portfolio. And if you can get some positions, whether they're stocks or CDs or bonds or dividend-paying stocks, now they're yielding more than they've ever had last 10 years. And that's going to peak out somewhere in these months of this year. That all goes with the Fed raising the rates. So if the Fed stops raising rates here, all the investments, the safe investments that you can get for 4 to 5 to 6%, they're going to peak out around right there. So that's kind of something to keep in mind. So it's time to start looking. If you don't have any yielding portion of your portfolio that's safer, kind of the next 6 months is a good time to start looking into those things. Let's see. Okay, the variables in the stock market. We always look at a couple major things: crude oil, inflation, dollar index, and of course we already talked about the treasuries, which are up 6%. I didn't want to repeat that here, but oil is up 7%. There was a news story that said Russia to cut oil production, sending prices higher. So this is kind of weird. They hardly ever do something like this. They usually go along with OPEC because they're part of OPEC. But they decided to punish the West by reducing their output, and that increases the price of oil. So it's supply and demand. The less supply and the higher demand, the higher the price goes up. And as soon as they cut this, the price of oil goes up. That's why the Exxon, all the majors, oil companies, and oil pipe companies are up today. You see. So it's not there's reduction in supply this time, because Russia took them off the market. See. And that's actually punishing the West, because it costs more to do everything, and that hurts the inflation, because almost every product that you buy has some kind of effect by the price of oil. All right, so inflation is coming down. It's currently at 6.5%, but it's averaged 1.8% for the last 6 months. So 1.8 to 2.3 is the running inflation rate. And if it continues like that, we'll be down to like the 3% inflation rate by the end of the year, maybe. The reason why you keep track of inflation is the amount, well, everything, the value of if inflation goes up 6 or not in a high rate, then the amount that you can buy with the money that you've saved goes down. So you have to keep up with inflation and invest in a way that you can have that your buying power stays the same or gets better over time. So let me see. So the dollar index is went up this week. So that's not so good for multinationals. It's just a temporary. It's been going down. So the chart for EXY, the dollar index, is going down. It's just happened to go up 1% this week. So the dollar is important because all the commodities are priced in oil, not priced in dollars, including oil. And let me see. So I'm not sure why this probably doesn't have a whole lot of effect on the price of oil spike today. That was because of this story. All right, so let's look at the sectors that are moving today. We know oil and energy is big because the price of oil going up. Let's see. Okay, there it is. Energy, oil, services, healthcare. Okay, so we're getting back to conservative stocks that are conservative. Seems like every day this year we've either had risk on or risk off. Today's a risk off day. All January was risk on, not a good portion of January. So this is what worked last year is working now. So let me see. Okay, so some of this commodities and gold very well might have to do with the price the dollar going up. Because when the dollar goes up, the value of the materials goes down. So let's look at some more things. Let's look at. Okay, look at where we are on the S&P. Okay, so this is pretty important. We're still technically in the downtrend. We started an uptrend right there. We broke out of it right here, but we're still in this small channel. And if we keep going up like this, and we start going above the moving averages on a regular basis, that's going to help us to have a momentum. And we need earnings to help us get by all these things. And that's one big thing we don't know about, how the earnings are going to be changing for all these stocks we're watching. As you can see right here, we're overbought. And the stock market has basically been going up for a while. Now it's starting to consolidate. So next stop for the Stochastics is down here. And that'll probably take us to the bottom of this channel. So I'm guessing we're going to be going down to here. And that'll take us to the next, could take us to the next bed, I don't know. But that's kind of where we are in the S&P. So we're overbought. We have a lot of people greedy, and so the primary emotion is greed right now. So there's people that are seeing prices go up in stocks, and they're kind of they're interpreting that as, well, the fundamentals are going to get better, and we're out of this downtrend. So What happened here is we had massive amount of short covering because everyone's watching this spot right there. And when we broke through this, we had a lot of major stocks that were shorted, and market participants were covering the shorts. So there's people that are saying that a good portion of shorts were covered in this small period of right here. So, and that could be a temporary, it very well could be a temporary thing. But that would explain why all the trash stocks, the stocks that have no fundamentals, that are ready to go bankrupt, and why they're going up double and everything. But we're like overbought right now, so at least we're going to probably go down to here before we'd be do anything else. So we're just a new pattern there. Almost every stock we're following in the tech world is following this pattern. But you got to keep that in mind. And we're still not out of the woods. There's a very good chance that we're going to be sideways for the rest of the year. So we have this little pattern here, maybe like this. And we're going to go sideways until the Fed provides liquidity to the market. And there are some that are saying we're going, like, let's review. Let's see. Okay, hold on. Okay, so we're at the 90 stochastics. We're going downward. So we always review this. This Dan Niles he's a really smart guy. He thinks the fair value of the S&P right now is 3,000, and there's a couple predictions that we're going to be stuck in this range. 50% chance we're going to be stuck in this range all year. Primarily because the earnings are going to be hurt by the recession. So don't get your hopes up that we're going to be hitting all-time highs recently. We're going to watch the earnings projections. All right. So, Leon Cooperman said, there's 50% chance we're going to be going here. Dan now says we'll be down here. Let's look. Dear greed. We were extreme greed last week. So now we're getting the greed. It's going down. The stock market's going down. As the stock market goes down, we'll get towards that extreme fear again. So let's look at our emotional chart and see where we are there. There we go. Okay, so I'm thinking where last week we were at this delusional. Everyone was extremely greedy. So extreme greed. Now the stock market's starting to go down. It's denial. We're going to start to get some earnings reports that aren't so great this year because of the recession. And we have, layoffs and people fearful, and you have to be ready for this capitulation if that ever happens. So I'm thinking we're right here. So you got to keep everything, all your emotions in check, and you can't be scared out of positions. All right, where are we here? Okay, so we're watching the VIX. The VIX it's still on a lower level. That means people are greedy when the VIX is low, and then when the VIX gets high, above 30, then people start getting scared. And I think the VIX, it's basically a volatility index. Tells you people buy calls whenever they're greedy, and they buy puts whenever they're fearful in general. And this kind of measures that. So right now people are still complacent. So you can see our 20 or 25 is like complacency. So the next step is fear. Like maybe next week we'll get into a point where you might have some bad earnings warnings, and then something that makes people fearful in the stock market. Then you get towards maybe panic. But you have to let them know this is an inverse correlation to the stock market. We usually see the stock market going up whenever the VIX goes down, and vice versa. So Right now, it's kind of saying that people are so too excited, it's going to go down. So, okay, so we were all talking about this. There's a new product called ChatGPT that everyone's talking about. It's the chat program that's basically type into it, and then type into it. It basically gives you a super detailed answer to your question. And Google, what's interesting about this is Google went down 100 billion, 10% when they tried to give a demo that was kind of a competitor to this. And it wasn't ready, and it had errors in it. So it was a bad demo. It cost them 100 billion in market cap. But I think that's unjustified because Google actually created some of the underlying parts of this ChatGPT. So you can't be that far off of the results of that ChatGPT. So I'm thinking Google is maybe a year they'll be better than what Microsoft has with ChatGPT. But the important thing to remember is that Google still has 93% of online ad market money. Bing only has 1%. For Microsoft though, this story is really important because if Microsoft can get 1% of the ad dollars, that's a lot of money. It's a couple $1 billion. So maybe 1 billion or 2 billion. So that's a new growth part of Microsoft that we didn't really talk about before. So Microsoft has like a super diversified residual income, and they're just adding to that. So that gives them a little bit more certainty. Certainty means confidence. Like that gives me more confidence building this stock, knowing that they have another diversified way to make money. So, any questions about this at all? Anyone have any comments? All right, no comments.
Yeah, you're saying, I don't know, that Google doesn't, always makes perfect products. I actually think my problem with Google is that they come out with a bunch of like half-baked products that they then don't follow through on. That they're really good at search, and they bought YouTube, and so I think the places that they focus on from the management get a lot, are very good products, but they also do all these kind of I don't know if they still do. It used to be like the 20% time products, the stuff where they would kind of create something on the side. They create a new chat program, and then they abandon it, or they're doing RSS like feeds throughout, and they abandon it. I don't know that Google often, it seems like in the company, people what's it called when you like create a team and build up at kind of the expense of other products in the company, kind of kingdom building, where if there isn't much incentive in the company to like, make this a better chat program, but we're gonna do Google Allo now because we had Hangouts before, Google Hangouts, and then we did Google Allo, and now we've abandoned that and we're doing something else. That they will, they can't make a good chat program, and they keep cycling through new ones, and then it kills the old one, and people lose confidence in the next one because it's like, well, I've already tried 2 of their products, and now this is the 3rd one of their chat things. I'm not going to spend time trying to get people on this because I've seen they're just going to abandon it in 6 months. So I actually think Google has a really bad reputation for kind of new products.
Oh, interesting. I think they call these moonshots. So they have a certain portion of their company that's spent on prototypes, and I guess a good company will cut it if it's not going to yield anything. So the good thing they stopped making Google Glass because that was a failure, and there are products that that don't catch on, and but the ones the interesting thing about this demo was they were forced into this. They usually make things super perfect. Like they're not gonna sell their Waymo self-driving to Ford until it's been tested for 10 years, right? And so they make sure things are perfect before they come out with a product usually. And this was so out of, I think it's really out of line what they do. They were forced into saying, we have a product like that too. Don't lose faith in us. And that caused this whole big problem where people are losing confidence. And you got to remember when you invest in stocks, whether, if you're using a new product, if we have no confidence in Mark Zuckerberg to make the metaverse anymore, right? I still believe in him, but the market doesn't seem to have much confidence. But confidence is really important. You got to give a confidence level for everything that you're invested in and price it accordingly. Like you have to say, well, my confidence in Google went down to 85% from 95%, over the past year or so, because you have a antitrust lawsuit. See this the sense where you're the unknown of the future. You don't know how they're going to be earning money if they have new rules imposed on them from the government or something. So this confidence level, when it starts going down, you got to start reducing, your commitment to that product. So there's a lot of unknowns for Google, and this kind of helped people lose confidence a little bit in the stock. So that's why you got to say, well, how confident are you that Procter & Gamble is going to continue to, have a demand for their products, going forward? And I think there's pretty good demand. They have good advertising, they have good product, and a lot of people still like their brand. It doesn't have any negative news associated with it, et cetera. So everything that you invest in, you got to give a percentage confidence. Just remember that, and then say, well, does this? So the demo doesn't have an effect on me, whether I'm going to sell it right now. I think whenever I see we're going to go over Google later on, the numbers, see if any of the analysts are changing their estimates on the stock. It seems like this 93% isn't going to change anytime soon. People aren't going to go to Bing when they got to book a flight and they got to find out something, right? They're going to use what they've used for their whole life, But so let's see if this 93% change at the time. But it's going to be a while before people have confidence in Google again. And it might be they throw all their efforts. They already started. They had this group memo, start testing our BARD product, our vendor to this AI. So I'm sure if they throw all their resources into it, they'll come up with something better than Microsoft. Okay, so that was a good lesson learned from this. But in general, this doesn't really affect their 93% of the online ad market. I don't think they're going to get 1% of the people to switch over and make it 92%. But if it does, we'll just have to keep track of that. But it's going to be 10 years before Google's replaced in search, I think. So, any other comments on that? Great. There's a comment. We keep track of Doug Cass. He's a writer for TheStreet.com and Seagreaves Partner Management Hedge Fund. Last year, we were talking about an article. He said Kathy Woods from Park Innovation is, she's investing in things that are not profitable. As soon as they lose confidence in Kathy, the price will go down for the stock. And he was talking about how all the electric vehicles aren't making money. And we were predicting, he was predicting, that they would go down. And so they did lose confidence. And now he's out with something else at this time. And he said he's shorting some of the market's biggest stocks, ones that we're following. And he concluded is that the optimism, so there was optimism in January where everything was going up. Everything that went down last year went up in January. So the optimism embraced at the beginning of this year and manifested in well above historical valuations. So he thinks it's going to be reversing. There's going to be lower price to earnings multiples that are paid for the stocks. So he went over all the stocks that he's shorting. And we're going to go over, let's see if his comments have any credence. And it's a good thing to do that if you have positions in stocks and so you have confidence because, we got to keep track of the analysts and what they're thinking. And what he's saying here is there are narratives on the markets, an attempt to explain daily moves. So we have narratives every day. If Tesla goes up 10%, the people on TV have to have something to say. Maybe it's because you fill in the blank. And he's saying there's just too many people on talking heads on TV saying why these are going up. It doesn't really make sense. And he says price is truth. Well, if it's going up, it must be a good stock. And that's influencing sentiment. So whenever people are greedy, let's look at our greed, fear and greed. Right here. When people are greedy and the price earnings ratio goes up and the valuation goes up, the PEG ratio goes up, that clouds your judgment. And he thinks we're like, right here, people just are overly greedy and we're getting to a point where everything's overvalued. And he thinks that we're going to be going back down to something where we paid maybe last year at this time. And what he's basically saying is all the stocks that are the bigger stocks in the stock market are going to go down to like a PEG ratio of 1. And that's kind of how I'm interpreting it. So we saw Tesla do that earlier this year. And he's basically saying that the major stocks, the big stocks, Apple, Amazon, Tesla, etc., they're going to be going down to a market multiple, meaning it'll be trading right around what the S&P trades for. So we like to keep track of what he says because he was right last year. And so do you remember us talking about that last year?
I think we did a bit, yeah. And the S&P PE ratio, it was quite high last year, right? And
right.
Last year was one of the worst years for stocks in a very long time, and bonds. So I guess I'm not sure where the big, but not everything here is a big tech company he's got. I'm not sure where like 3M is, or Boeing for that matter. I could go look, but yeah. The S&P valuations are PE ratio is around like 21 or so right now.
Yeah, it's around 18 to 20.
Yeah, so I think it could fall more, but it's not gonna. I don't think we're gonna have a year like last year. I think it's much more likely this year is gonna be a stock market up year. But we've already had a 23% gain this year so far, so maybe that's already happened. We wouldn't be going up more.
Right.
But yeah, so we've already recovered quite a bit from the big fall. But it seems like there's not so far that it could go before things have actually gotten a lot more reasonable pricing than it was. I feel like in the past. So.
Right, I agree with that. I think what I did was I took a couple of the biggest ones from this, and I'm looking at, if we do crash or have a market fall like we had with Tesla before, we noticed that Tesla stopped at a PEG ratio of 1, and if we do have a fall in these big stocks, we have to look at what could be a point where they're fairly valued, perhaps, and we'll see how much overvalued these stocks are. And so, okay, so I think he's been always right. He's been right, through the big craziness of last year, right after the I mean, he mentioned right when the pandemic was at its worst, he said it's time to buy. So I think he has some pretty good instincts. So we're going to look at Microsoft, Apple. No, I'm sorry.
So okay, I'm not sure what's going on with 3M, but 3M right now is a PE ratio of 11.19. I don't think that 3M has that far to fall, right? 3M's a pretty meat and potatoes business.
Well, the problem with 3M right
that's
now,
some sort of giant lawsuit I don't know about.
Yeah, that lawsuit. They have, and that reduces the confidence level of the average investor, right? So if you have this, how much are you going to pay for thousands of military people losing their hearing? I mean, wow, that's hard. That's why it went down that much. And it's overvalued. 3M is probably a bad stock to add in that list because it's so it's down for a different reason, and its multiple isn't. He said the multiple was going to go down. We're going to look at rent. We're going to look at the statistics for 3M just to see if it has a high PE ratio. Now let's look at the statistics. PEG ratio. So it's 3 times overvalued. Its full PE is 11, and it's wow. That's really low. You're all right. And it's let's say it's growing at 5%. So there's not much room for that to fall. But if there is some bad rulings, and they end up losing more of their court cases, this could go bankrupt. And it's the same thing with J&J. So I think that doesn't fit his narrative there for, all these stocks are.
Yeah, but there you're betting on, that's a different, matter, right? There you're betting on what's going on with court cases and stuff. And Johnson & Johnson just, they just had a setback. They were trying to contain their fallout from the baby powder thing.
Yeah.
And the bankruptcy court didn't like some of what they were doing there. They're trying to figure out how to pay out and make it more fair in the payouts, and that's a pretty complex case.
Yeah, that's going to be hard. That's going to be hard.
Even if they fail the cost case and they lose the cost case, they still have different way to drag out the thing without going bankruptcy. You look at a cigarette company, so many cost case and they still alive. Besides M&M's is very diversified portfolio. They have a lot of product from global, right? I don't think they're going to go bankruptcy anytime soon, or ever go bankruptcy.
Yeah, the problem with having something intangible like a possible, large lawsuit is you lose the confidence. Confidence.
Yeah, that's J&J, yo. That's not Triple M's. Triple M, they can put up a different fight, different strategy.
Yeah, it's similar, but it's different court case. So I'm going to look at 3M. It says the PEG ratio is 1.9, so we expect it to be growing at 5% per year. Let's see if so that's not a sky-high valuation. Let's look at the earnings and see if it's even growing at all. I expect it to grow. Whenever you get into cases like this where you have court proceedings, they spend a lot of money on lawyers. So maybe that's affecting their earnings. Okay, let's look at from this year, 8.65 divided by 9.20. That's 9%. 9.50 divided by 2.5. 5%. 1.5 divided by 7%. So it's growing like 7%, 5 to 7%. So not very exciting. It's a slow growing company. It pays a dividend, but I guess it doesn't really fit this. Okay, so let's throw that one out of this the reason why. But the other stocks, yeah, they do have higher PE ratios. I'm going to go over Microsoft, Apple, Alphabet, and Amazon. We're going to look at why we have confidence or, lack of confidence. And you have lack of confidence, such as whenever a company reports bad forward projections, or if they have a bad earnings report, they lose that premium that's paid for their company. Okay, so let's look at Microsoft. Microsoft is it's growing at between 7 and is this Microsoft? Let me look what this is. Okay, this is Apple. Okay, so Apple is growing around 7% a year. That's not that great. Usually, and its PE ratio is 25. So if you divide the PE ratio by the growth rate, you get a 3.5 PEG ratio. That is really high. So in a really bad market, you divide the current price by 3.5 and you get a, let's see, and you get a fair value. So let's do that calculation. Must not do it right there. So it's currently trading 150 divided by 3.5, 42. Yes, yes. So the fair value price is $43. But why is it selling for a premium? It's selling for 3 times, what's growing at, and that's because they have a moat that other companies don't. They have 2 billion devices in use that they're selling services to, and they're adding to those services, and that's a residual income, and that gives them a certainty of cash coming in, and that's really important. And they do have innovative products coming out like every 7 years, a new product, and they have a growing ad revenue, and they have a cloud division, and they have loyal customers that upgrade on a regular basis. So those are the good things about why they're trading at a premium. Why would they go down? Why would they go down to a PEG, let's say a PEG ratio of 1, it's $43 a share. They would go down because there's some kind of corruption in the accounting, and if there was like a bad news story like that, or if they had bad earnings projections, people would lose that confidence in the company, and then they would basically go back down to, I think maybe a 1 PEG ratio, which is $43 share price. So so Stochastic is right with Apple in a big way. So it can go down lots. I'm holding it because I know it's growing at 7%. And it costs for me to sell it, and take capital gains. And you have to be right 3 different ways whenever you're selling something. You have to be right and sell it at the right time, number 1. Number 2, you have to figure out when you're going to get back in, and then what you're going to buy when you get back in. So it's 3 decisions you have to make and be right on. And for me, if it's still growing at 7%, in 4 years it'll be fairly valued if it stays the same price. That's kind of the way I'm looking at it. And they're buying back their shares too. So that that makes the fundamentals better. So let's look at the next one. Next one is Microsoft. Now look at this is from E-Trade. It's the average earnings estimates. And they're going at 13 or 14%. And a lot of that is cloud growth. And of course, we have, not in these numbers, we have possible ChatGPT taking a chance, which might help their advertising ad revenue go up. So, for ads. And so I looked at they're trading at a PE ratio around 25. And that's still high. So Doug Cass, when he said, all the big techs are trading the high PE ratio, and it's going to come down. That means he thinks the PE ratio for Microsoft will go down to like what the PE ROE for the S&P is like 18 or something like that, or down to its growth rate. And growth rate is around 14%. So if it's in the math here is we know that the PEG ratio is 1.7. It's growing at P of 25. Divide that by the growth rate, and that gives you how overvalued it is. So the fair value of Microsoft is around 154. In a really bad market, this is what it'll trade down to, like a really bad stock market. So you have to keep that in mind as like a stopping point, something where, it'll hover around there, and then probably go up. Why are people paying, 1.7 times what it's currently growing at? It's one of the remaining AAA-rated companies. Johnson & Johnson is the other one. It doesn't need to borrow money. It's diversified, and it has residual income from very different businesses, and they're growing those businesses. Yeah, that income from different places all the time. They're actually getting into, within the past year, they bought Nuance, which has the healthcare record maintenance. So that's an example, a way to diversify into different ways. They have a Windows and Office monopoly. I don't know how they get away with that, but they do. They're currently integrating ChatGPT into Bing and taking very, very, very small amount of share from Google over time. But those are all reasons why that they have that premium. And so we'll watch the 154 level, whatever it gets down to there, that's probably the fair value. So far, Dougcast has been right. Everything is overvalued. Let's look at Alphabet.
Quick question on
yes.
Integrating ChatGPT into Bing. The only problem is rarely any people use Bing. How much of that would taking market away from Google then?
I'm thinking less than 1% over 5 years. Because, like I was saying earlier, it's like once you need something, you need to know. I need to know the best place to buy a certain thing. That's one of the most common things. If you want to go and buy something, you look on Google, and then you go to Amazon. Then you have your method of doing your research on the internet. How many people are going to switch from that using Bing? I'd say less than 1%. But if it has some kind of buzz factor, maybe that might change. The AT&T landline phones, no one thought, the government thought that was a monopoly, and nothing could ever replace that. And they broke them up, and who knows how Google might be displaced in the future. We don't know. But we got to keep track of that and, look at the merits. And I'm looking at ChatGPT. It's not a Google replacement yet. And we'll see. What do you think? How many people do you think will switch? Percentage-wise, out of 100 people, how many will use Bing 5 years from now instead of Google?
Switch to ChatGPT?
Yeah.
There's nothing. I think they will be using both.
Do you think they'll use both?
Yeah. They'll use both. There's nothing like. But this is what I have experienced in last few weeks. That ChatGPT has a certain kind of precise answer that they provide, but do people want some more answers? Yes, they want to read a little bit more. Like, even though you give a one precise answer, people still want to go dig in more, a little bit more, where Google plays a role, where they have different kind of answer, different kind of research or analysis done by different websites. So they want eventually it's ChatGPT basically give you only one answer, just precise one answer. That's how it does. If you ask the same question again, they'll just respond to the same answer. in case of Google, what Google does, when you do a Google, it gives you multiple websites. People would like to go to the multiple websites and take a look at it. How exactly other people have done their analysis and maybe make their call on the basis of that. So yeah, definitely you'll be using both.
Okay.
Yeah, I think there are two things here. One is that any sort of shakeup in how search is done, it is an opportunity for anyone other than Google, right? As the reigning king, if there's some sort of change in how it works and how people search, that's probably bad news for them because they have to fight for it. What does ChatGPT do with one or two word, just you give it 2 words, right? Because that's mostly how people search. I think is they're hotels Boston, or they're Queen of England, right? You're just Queen of England, you don't want to write some sort of big question.
Well, I asked a couple of short questions, and they say, please give more content to get more accurate answer. They ask for more content.
More context,
yeah.
Because I think most searching I do, I'm putting in 1 or 2 words. I'm not writing out sentences.
The one thing about Google is they come back with a lot of external link that really confuse, and you have to go through the list. ChatGPT, what it does is it trying to it doesn't give you that much of a link. It gives you an actual answer. So that's an advantage over Google. You don't have to go through 100 links to find one thing that you want. But how would ChatGPT fine-tune the data into a single one that they could provide to you? How accurate it is, it will remain to be seen.
ChatGPT is basically whatever information is there on the web, whatever you have fed into the bot. That's what it's gonna look into, and the best thing about ChatGPT is just put it in a very precise answer, very nicely framed answer.
Right, but Google have an advantage over it because they have a big data, data set that it
correct.
Get from. So if Google come up with a new AI chart, that it would be likely more accurate if it provide answer, because it can train its model to have more data with more data.
Yep.
Good. Well, I have to roll on because we're almost done here. I have one more comment.
Oh, just if you have time here, Greg, I wouldn't mind you doing a little bit of analysis on Ford. I'm trying to understand Ford.
Okay, let's look at that. So Ford, they had a really, we were talking last week about their earnings report. It was a bad earnings report. Let's look at the stochastics on Ford right now. We'll keep track of where it's currently. I think it's sideways right now.
It went down 6% today.
There it is. Okay, so I traced this out. We're still in a downtrend here, so we can either be in a downtrend or a sideways. I think it's more of a sideways right now. Look at that. So the bottom of this is about 11. And the top of the trend is probably around 15. So 11 to 15. It looks like we're going sideways in Ford right now. Let's look at the statistics. And look at I'm sorry?
Yeah, it's paying a 4.5% dividend right now, which is a lot more than some of its competitors, I think.
Oh, right. Let's look at the numbers for Ford. Okay, so we're going to get our calculator out here. See where this is going. Earning. Okay. We'll go 1.51 divided by 1.63. That's 7.5%. 1.63 divided by 1.80. 9%. It's going down after that. So this is interesting. Look at this.
That's a weird thing. 2026, the earnings go way down. Huh.
A lot of times, whenever companies, like drug companies, they know they have a patent cliff. They're not going to be able to sell a certain drug after a certain date. You see it like that, but it's really interesting. Maybe a lot of their competition is coming out. One thing that was bad about their earnings report, they said they had to reduce their price, on their EVs because Tesla reduced their price. So that's reducing their profitability. I guess what they see here, possibly in year 2026, they're going to be, let's look into, but this wasn't, going down, last time we checked. So let's look at the statistics, just for fun. 4P is 8. So what numbers do you see there? There were about, don't forget the numbers already. Okay. So it's not as compelling as it seemed before. So 1.52. So it's 8. They're growing at 8%, and then the PE is 8. So they're fairly valued right now. But if they lose, we'll watch this year here. That could change. It takes 3 years to get there. But they're about fairly valued right now. Let's look at the PEG ratio is when it's 0.48. So Yahoo thinks their earnings are growing at 16% a year. So according to, we'll do it. How about this? We'll do a deep look at this for next week's because I'm always interested in Ford. The key here is that Tesla is kind of the leader of this group right now, and if they're reducing their prices, that reduces the profitability of Ford, and their earnings projection is going to go down. They're not going to be able to charge as much per vehicle as originally thought. So I think that they've fixed all their problems with components. They basically said they don't have any sourcing problems for the products. But it's really interesting why. Let's see, a lot of these numbers are turning negative, probably because that last earnings report wasn't so great. So let's look at the last earnings report. It was probably, there it is right there, Q4, negative 11. So it was worse than expected earnings. So you can see that on the fourth quarter, they always have problems. Companies usually, whenever you're looking at a stock and looking for their growth over time, you have to look at quarter over quarter because people buy more iPhones at Christmas time, so you have, more sales at fourth quarter. So let's look at quarter three. So this is an example of the inconsistent. It's becoming inconsistent in its earnings, so you have a less confidence in the stock. So there was a negative 18% earnings miss last time. So that's not good. I'm not sure about this. I think we should look at reasons why the earnings would go down after 3 years. We saw, Facebook's earnings to go down. Let's look at Facebook, see if they've changed. We saw Facebook's earnings because they're investing in the metaverse and they're putting a lot of Facebook on. What do you think, Matthew?
No, that was helpful. I wasn't here last week, so.
Oh, okay. I'll do a deep dive on this. And a lot of times it's not just the fundamentals and these numbers that you're looking at. You have to look at the competitors' valuations. And
yes. So Toyota seemed like they have a higher PE and they're not paying as much dividend. And so I was trying to understand why Ford. What's going on with Ford? Okay.
This is it's amazing. I follow Jim Cramer on his Mad Money. He's always championing Ford as this, an American company that's continuing to grow. But you got to look at all the other companies, how they're doing. whether they're in favor or out of favor. One thing I did here, let's look at Tesla, because I mapped Tesla out recently. Okay, Tesla short covering. That probably, so we have a downward trend in Tesla, right? And I think they're the leader in this EV category. And you can see they're at the top of their channel. And a lot of times, the competitors, Ford is actually not a leader in EV, Tesla is. But whenever you have the leader of the EV, you have to follow that and see possibly where the other stocks go in that industry. And it looks like the next stop for Tesla might be down here. That's where it's a big ratio of 1. This kind of goes with Doug Cass's idea where you have higher valuations. And right around here, Tesla's fair value is about fair value. It's like a peg ratio of 1. So we might be in a time where we correct back to fair valuations for a lot of stocks, because when we're looking at the big picture, we're still pretty much going sideways until the Fed stops its raising rates. So I'm thinking we're going to be the next stop. We're overbought right now, so the next stop could be a little lower in the near term for a lot of these stocks. But I think, we'll go with Ford next week, and we'll do a comparison with GM. GM had better results and better valuations than Ford recently. But when it has a 4.5% yield, you have to say how reliable is that yield? And I'm not sure. So we'll look at that next time. Any other comments about Ford?
Also, I would like to know how much of market share Ford had in terms of EV. I mean, how much of earning Ford receive from EV vehicles? Because they could be impacted by Tesla reduction of price on EV, right?
Oh yeah, I agree with that. I think when the leader in the group reduces their price, it's not only the price of the car that's affected, it's the used car prices. All those go down. You have dissatisfied people that they just bought a car and the value of their car depreciated 20% already. So you lose confidence whenever you reduce prices sometimes. But I think the price of the commodities are getting stable, so it's not as out of control as it was before. So I guess, we'll do it. Next week we'll do some EV. We'll look at EVs. I'm interested in EV charging. The president gave a talk. I was listening to it, and he said we're going to have an EV charging network. And whenever a government, whenever the president says that, the government's going to throw money at trying to get people to implement this EV network. And
the government already did.
They already did. Okay.
They
So
increasing the subsidies for EV, the discount tax return thing.
yeah. So I saw Tesla modify their price based on that. So they saw an advantage of changing the price of their car based on that EV tax credit. So, but if they fund an EV charging infrastructure for the country, that could be great for the EV vehicle makers and for charging companies, and maybe companies like or energy companies like Exxon or something like that might get into that. Just think of how many I'm not an expert at this, but we don't have enough charging networks in America yet.
I would think the Exxon Mobil and all of the gas company would go against us because more people ride EV, would be less people riding gas. car.
Right. But if you offer both, then
They're not diversified. One of your gas company is FDP. None of them diversified.
That's right. But Shell just bought a company, an EV charging company, a really small one, but
Yeah.
that's an example of a company that's oil related. It's getting into electric vehicle charging. So
EV is way ahead of Exxon, and they not even diversify that much. Exxon is 100% in gas and nothing else.
well, they have natural
They
gas.
just bought
too.
that company, but how they going to neutralize? I mean, getting the benefit out of that would be a big question.
Yeah, that's probably one of the biggest questions, and the fear of not having a charge is still in people's mind. When they're driving their EV. So okay, I think about went over my time, but that was a real good discussion. Next week we'll go over Ford competitors, see what other companies are trading at, and see if we can make sense of what are the good stocks in that industry. All right. Well, thanks for attending, everyone. I hope you have a good weekend.
Okay, Craig.
Thank you.
Thank you. See you next time.